I want to start, first of all, by getting a perspective on what is going on across the yield curve. I've seen dramatic changes we're seeing since we saw Nigeria added to that JP Morgan index. We're seeing the 10-year at 14.5 compared to 16.4, 2 weeks ago, thereabout. What exactly is going on?
Thank you for having me on the show. On this program, we have rightly maintained that yields at about 16.5 and above was a gold mine, and the market was just rightly waiting for the right opportunities to cash in on their position. With the listing of the Nigerian bond on the JP Morgan bond index coming as proposed, market has taken a turn and yields have been driven southwards. What we have seen is a huge interest coming from portfolio investors and foreign operators in the fixed income space. We have seen yield tumbled from an all-high of 16.5 to as low as 13.5 on the 20-year instruments on the yield curve. This situation is unconnected to the fact that the JP Morgan index presently have yields at about 15.5 to 15.8, and suddenly there's an exposure coming to investors from a market that will be offering yield for as high as 15.5 to present levels of 14.5 even.
Right, but did you just say the JP Morgan index, is it 15.5, 15.8 or 5.8? Because what I heard was that the average on the index is somewhere around 5.8 or thereabout.
Yes, about 5.8.
All right, so very, very, very interesting. I'm sure a lot of investors will be interested in our market. But the question is, do you think the flow will continue at this pace? Someone was suggesting to me that many investors that were looking at Nigeria thought 15% was a good yield when it was about 16%. So they were still interested at that stage. But now we're seeing that yield come down to below 15, now closer to 14%.
Well, feelers from the market rightly suggest, and for participants, that the foreign investors have continued to find these yields very attractive, compared to where they are coming from. The fact is that I can confidently tell you that it is hardly very inevitable that the domestic sector will be buying yields at this level. So obviously, from what we can say, and from feelers of information coming into the market, the foreign investors are rightly still in this market, and we think that this trend will continue for a time. However, dealers should be very wary of this volatility, because we have seen such events happen in the past, and the fact is that along the curve there could be profit taking and market could take a turn.
Okay, and then your thoughts on the market conditions for the bond switch that the Debt Management Office was planning. We haven't heard much about that recently. In fact, what someone is telling me is that it's actually behind schedule. I thought by now we should have seen that bond switch program coming, what many people are calling Nigeria's version of Operation Twist.
Yes, like you have rightly noted, the bond switch was scheduled to hold in August, a week after the auction last 2 weeks. But we've not heard from the Debt Management Office. We believe they must be watching recent developments in the market, because that would favor their strategy. And part of the issue
Why would it favor their strategy?
Part of the issue that has been in the market was on what yields the Debt Management Office would peg its source bonds for its destination bonds.
Right.
Market was of the view that they would need the Debt Management Office to give it an incentive, since yields were at a high of 16.5 as when this proposal was made, and presently, market was carrying some of those source bonds at between 10% yields below. So that would create a huge revaluation loss to market. However, with recent developments, we may see the Debt Management Office revamp this strategy on policy to switch short-term maturities. The 10.5 November 2013 maturity was scheduled to be switched for 50 billion of present 15.1 April 2015 and 16% June 2019 maturities. However, market is keen to see how this would happen, because it will have its own impact in trading.
All right, you just talked about they had to switch the October 2013, which is like a year away from now. But can you give us a sense of the deadlines they need to work with here? Because clearly, as we approach the maturity of these bonds, I think some people may be jittery.
Well, Wole, I will rightly tell you that we are dealing with regulatory authorities. Market cannot give them deadline. They do at their wills and caprice. Whenever they are ready, they will issue a circular and market will be willing to oblige.
But the point I'm trying to make is that when does it become a little more treacherous, the delay that is? At what point do you think that it now becomes an issue that that may cause some volatility in the market?
Well, until the proposal is given to market, until there's a firm timeline to it, market will continue to look at it as speculative. Aside from it being that it's about a year to maturity, that's not the only source bond that has been penciled down for switch. Bonds ranging from between 1 year to 17-year tenure to maturity has been penciled down from switch. So even if this doesn't happen, we may see another source bond being proposed to market.
Okay, now let's move on to the FX market. I think the market conditions are fantastic for the Naira now. We are seeing the Brent crude at close to $113 per barrel. We're seeing the external reserves close to a year high. And of course, we've seen the net open positions for banks reduced to 1%. Give us a sense of your thoughts on where the Naira is today. I had the trader yesterday at 158.2.
Yes, present Naira exchange value to the dollar is as a result of the huge inflow that has been coming to the Nigerian market due to foreign participation in the fixed income space. That has helped liquidity inflow into the market. Also, market sees the central bank offer of 180 million as adequate to reach for its demand. And we think that present levels will be sustained owing to the fact that there will be little room for speculative attack on the Naira owing to the cut in NOP of banks.